Hello everyone, and welcome back to our weekly financial market outlook. How will they move this week? Let's get started. This week's theme is, how far will the yen move before currency intervention? Despite the Bank of Japan's rate hike, the yen continued to weaken, with USD/JPY reaching the upper 157 yen range. Why didn't the yen strengthen? And at what level does currency intervention start to become realistic? This forecast is based on an AI-assisted statistical analysis using more than 200 weeks of historical data, including exchange rates, interest rates, and 17 other financial markets. First, let's take a look at this week's convergence points, in other words, our profit-taking targets. USD/JPY is 155 yen and 1 sen. EUR/JPY is 181 yen and 49 sen. AUD/JPY is 102 yen and 47 sen. The Nikkei 225 is 48,725 yen. The Dow Jones is $47,613. The 10-year JGB yield is 1.98%. Gold is $4,209. We expect the market to stabilize around these levels. Why the yen weakened despite the BOJ rate hike? The Bank of Japan implemented a 0.25% rate hike, in line with market expectations, raising the policy rate, the basic lending rate, to 0.75%. However, during the post-meeting press conference, the BOJ was perceived as being cautious about further rate hikes, which led to a rapid acceleration of yen depreciation. Financial Minister's remarks and market reaction. Finance Minister Satsuki Katayama commented on the weakness, saying, "Over the past half-day, or several hours, the moves have been one-sided and rapid, and we will respond appropriately to excessive movements." Following these remarks, the yen's decline temporarily paused. However, in the New York session, yen selling resumed, and USD/JPY briefly reached 157.78. When is currency intervention justified? Minister Katayama evaluated the BOJ's decision as necessary for the sustainable and stable achievement of the 2% inflation target. At the same time, she stated that it is desirable for exchange rates to move in a stable manner reflecting fundamentals. In the November Japan-US joint statement, currency intervention is explicitly limited to cases of excessive volatility. In other words, if exchange rates deviate significantly from fundamentals, coordinated Japan-US intervention can be justified. Should USD/JPY accelerate toward the 160 yen level, the likelihood of currency intervention would rise sharply. Why didn't the yen strengthen? One major question many investors are asking is, why didn't the yen strengthen even though the US cut rates and Japan raised rates? One reason is that Japan's real interest rates remain negative. The fundamental difference between Japan and Switzerland. This brings us to an interesting comparison between Japan and Switzerland's monetary and currency policies. Switzerland has kept inflation extremely low, maintaining real interest rates at around 0%. When import-driven inflation pressures rise, the Swiss National Bank allows currency appreciation or actively intervenes in the foreign exchange market. The concept of currency defense. The Swiss National Bank prioritizes protecting the value of its currency. It uses exchange rate management as a tool for price stability, and pursues policies designed to protect the overall wealth of its citizens. In contrast, Japan appears to incorporate currency weakness into its growth strategy. GDP per capita tells the story. Some argue that a weaker currency increases GDP and is therefore beneficial. However, when we look at GDP per capita, Japan approximately $32,000, Switzerland approximately $103,000. The difference is striking. Many people feel that life was far more comfortable when the exchange rate was around 100 yen per dollar. The risk of prolonged yen weakness. If the yen continues to weaken, there is growing concern that Japan could face challenges similar to those experienced by countries like Turkey, which has struggled with severe currency depreciation. Japan is one of the world's largest net creditor nations, in other words, one of the wealthiest countries globally. This is precisely why the Japanese government adopts a stronger currency defense mindset and actively correct yen weakness that deviates from economic fundamentals. Year-end and New Year market risks. From next week into early January, market liquidity will decline. As a result, price movements are more likely to become volatile. Markets may move sharply in one direction. Additionally, with more holidays, FX swap rates tend to rise, which could encourage more investors to hold long USD/JPY positions. USD/JPY warning zone. Under these conditions, it is entirely possible that USD/JPY could reach the 160 to 162 yen range, commonly viewed as the currency intervention warning zone. Please note that the above predictions are based solely on a stable convergence model derived from statistical analysis, and we accept no responsibility for the results of any investments made based on these predictions. In the future, we will continue to provide forecasts based on data and statistics. I hope to see you again soon. That concludes this week's outlook for the financial markets. Thank you very much for watching.